How does a collar strategy work with LEAPS? Are you curious about how a collar strategy can work with long-term equity anticipation securities? Let's break it down in a simple way. A collar strategy is a popular method in options trading. It involves holding a long position in a stock while also buying a protective put option and selling a covered call option. When we bring long-term equity anticipation securities into the mix, things get interesting. First, let's talk about that long stock position. This means you own or buy shares of the stock you want to protect. This ownership is the foundation of the collar strategy. Next, you will purchase a long-term equity anticipation security put option. This option has a strike price set below the current stock price. Think of it as insurance. If the stock price drops significantly, this put option gives you the right to sell your stock at the strike price. Since long-term equity anticipation securities have expiration dates longer than 1 year, this protection lasts for a more extended period, which is great for those looking to hedge against risk over time. Now, while you are buying that put option, you will also sell a long-term equity anticipation security call option. This call option will have a strike price above the current stock price. Selling this call option generates premium income, which can help cover the cost of the put option. However, keep in mind that by selling the call, you limit your upside potential. If the stock price rises above the call strike price, you may have to sell your stock at that price. Both the put and call options usually have the same expiration date. This alignment helps ensure that your protection and income generation occur over the same timeframe. The put strike price is set below the current stock price to limit losses, while the call strike price is set above to limit gains. The collar strategy creates a price range around the stock value. This means you have limited potential losses and gains. It is ideal for investors who want to protect their profits or reduce risk but are okay with sacrificing some upside potential. When considering costs, the premium you receive from selling the long-term equity anticipation security call can offset the cost of buying the put. Since long-term equity anticipation securities have longer durations, their premiums are often higher than those of short-term options. Choosing the right strike prices is essential to balance the cost of protection and the income generated. This strategy is especially useful for investors with significant stock positions who want to hedge over a long period without frequently adjusting their options. It is also a good fit for those who are moderately bullish or neutral on the stock but still want to limit downside risk while earning some income. In summary, using a collar strategy with long-term equity anticipation securities combines long stock ownership with long-term downside protection and income generation. This approach helps manage risk while allowing for some potential upside.